let's dive right in. We are looking at the setup for tomorrow, Tuesday, January 27th, 2026. And if you've been watching, you know the Nifty 50 closed at 25,048.65. But the exact number is almost secondary here.
It is, yeah. The environment is what matters.
We're walking into what the street is calling a high gamma event. You've got a monthly derivatives expiry.
And it's clashing with the market reopening after a 3-day holiday. That's a lot of pent-up news.
It's the perfect storm for volatility.
It is. But, looking at the research, the real headline here is it's a structural shift. The whole buy-on dips era, I think it's over.
It's done.
We are firmly in a sell-and recovery regime now.
That is a massive psychological pivot, isn't it? For so long, every single drop was just seen as a discount.
A buying opportunity. Yeah.
And now, any rally is being looked at as an exit door. And there's a very specific technical reason for this mood swing.
The 200-day EMA. The breach of the 200-day Exponential Moving Average at 25,162. That is, look, that's the line in the sand for institutional investors. It just is. When we slice below that level, the long-term trend signal flipped. Bullish to bearish, just like that.
So now if we get a bounce back up to that 25,162 level.
The big money isn't looking to buy more. They're probably looking to sell into that strength. Unload positions.
Okay, but here's where it gets tricky. Even with that broken trend, the momentum indicators are just screaming.
Screaming that we've fallen too far, too fast.
Exactly. The RSI, the Relative Strength Index, is all the way down at 29.12. We're in a sort of momentum vacuum.
It's the classic paradox, right? Structurally, the chart looks awful, but tactically, it is so stretched.
Anything below 30 on the RSI is technically oversold.
Right. It's like a rubber band pulled so tight to the downside that it just has to snap back a little. Physics almost demands it.
And the betting patterns, the options data, it seems to back that up. The put-call ratio is hovering around 0.59.
Which is really low. I mean, usually anything below 0.6 is a big contrarian flag.
It suggests the boat is just way too crowded on the bearish side.
Exactly. When literally everyone who wants to sell has already sold. Well, who's left to push prices down?
And that's the setup for a dead cat bounce.
Or a short covering rally, yeah.
Yeah.
The sellers have to scramble to buy back their positions, and that gives the market a temporary lift.
But let's be clear, a bounce is not a recovery. The global headwinds are just fierce.
Oh, they're bad. Gold just crossed $5,000 an ounce.
And the rupee is hitting record lows, near 91.99. That is a heavy risk-off signal flashing red.
It makes foreign capital so expensive, which just puts a lid on any potential rally. So, we're really looking at a battlefield defined by two key levels.
25,000 as the floor and 25,200 as the ceiling.
That 25,000 level is the fortress. You've got, nearly 97.5 lakh put contracts there trying to defend it.
Huge wall of puts if that floor cracks.
It could get ugly fast. And on the other side, 25,200 is what they call max pain for the option writers.
So knowing all that, how do you actually trade this mess?
Well, the sources are pointing to three very distinct strategies.
Yeah.
It all depends on how the market opens.
Okay, let's break them down. Scenario A, you think the fortress holds. We stay stuck between 25,000 and, say, 25,300.
Then the play is an iron condor. You're basically betting that time decay theta is going to do all the heavy lifting for you while the market just churns. It's the conservative play.
But what if 25,000 breaks?
Then you pivot. You switch to a bear put spread. If that huge psychological floor gives way, the drop to 24,800 could be violent and fast. This strategy lets you capture that downside, but still capture risk.
And scenario C, for anyone who doesn't care about direction and just expects chaos from that 3-day news gap.
That's the long straddle, a pure volatility play. You're betting on a gamma explosion.
You don't care if it rips up or crashes down?
Nope. You just need a big move, either way, to pay for the strategy.
So the takeaway is, watch the first 30 minutes like a hawk tomorrow. If the Nifty holds 25,000.
Expect that tactical bounce. Probably right back up to 25,162, that old support, which is now the new resistance.
And we have to remember, the union budget is just around the corner February 1st. Plus, earnings from heavyweights like Rupee and L&T.
Those are the next big drivers. This expiry is just the appetizer.
So I want to leave you with one final thought to mull over. With the VIX so high and this sell-on recovery mindset really taking hold, are we seeing a true healthy correction here? Or is this whole drop just a big liquidity hunt, a way to shake out all the weekends so the big players can load up on the cheap right before the budget resets the entire board?
That is the multi-billion rupee gamble, isn't it?
Thanks for deep diving with us. We'll see you on the other side.